potential run on liquidity. Now, for a scalper, it's good to have these ideas because we're working off the daily time frame. Everything I've taught you in the mentorship is being drawn into this. So I'm taking a great deal of liberty in expecting that you know the things I'm showing you here. Okay, what a breaker is, what a rejection block is, turtle soup, market structure shift. You all should know what that what market structure shifts are. But then we have the liquidity pool resting below equal lows here, and then obviously the bearish order block. So while it's like this, okay, we have ranges in here to work within. We have the highest high, the lowest low, and right in here, we're at or above equilibrium, and we're anticipating a move lower. So going back to the IPTA data range, you can see how price did in fact reach through all of these lows. Okay, and then we're going to take a closer look. We're going to drop down into a lower time frame at these same price levels, or these red lines. Okay, so we have an hourly chart here. So you can see how price has gravitated towards moving to and just below these levels. Okay, so IPTA is seeking liquidity below these known price points. So if we have them on our chart, obviously we're going to be much more well informed than the retail-minded traders, or, dare I say it, some of the pseudo-professional traders. Okay, so I shared this chart also in the forum, and I want you to take note of how price did in fact seek liquidity below previous day's lows. That's what the PDL stands for, previous day low. It doesn't mean, and it's not defined specifically as yesterday's low. Okay, and what I'm saying is it's a previous daily low, but it's defined as such inside of a range of the last 20 days. In this case here, we're looking at just till last Friday from the time of this recording, February 28th, 2018. So here's Friday's low. Okay, and here's Sunday's trading, and I gave you in analysis pre-week that this was going to probably be our optimal trade entry sell-off for the week. Now, I didn't know if it was going to be on Monday. I don't always know that, but that's the area at which I was looking for it to trade to. So if we know that we're likely to see this scenario unfold, then Monday or Tuesday or potentially Wednesday, the market could have rallied up to that price point. Now, since we saw all of this premium being built in, our eye goes immediately to this low right here, because this is our anchor or fulcrum point. The low up to this high, this is going to be used for swing projection at the last slide of this presentation. So just remember that all this build up here from Friday going into Monday's high, that's all being built as a premium. And we'll look at that as a tool for grading our price swings and also looking for swing projections on the week. Okay, so now let's get into the nuts and bolts about this. We're going to be defining buy programs. Now, a buy program is simply when we're looking to be a buyer. What are we defining it as? What makes it a buy program? In other words, why are we only focusing on one side of the marketplace, in this case, of being a buyer? Well, buying only when the daily has taken out a swing high in the last 20 days IPTA data range and not in a premium. Buying can be considered at equilibrium of the daily range of the 20-day IPTA data range, and parabolic expansion runs will be above the equilibrium level of the 20-day IPTA data range as it targets the previous day high and its liquidity pool above it. Okay, so we have our range here, premium and discount. We have the lowest low here and the highest high here. As price takes out this swing high here, right here, everything moving towards this level here could still be used for buys. This would be a daily time frame also. So these are daily candles. Okay, the buy entry process. When in a buy program, Monday through Wednesday is ideal buy days in New York session. Thursday can still be considered as a long as the liquidity remains for low resistance liquidity runs. In other words, if We haven't blown out the liquidity pool yet. Thursday still can be considered, but if I were trading that day, and it's rare that I do, but if I did, my leverage would be dialed way back. I'd probably be doing anywhere between 25% to 40% of what I would normally be trading in terms of leverage, simply because we're so late in the week, long in the tooth on the range, so I wouldn't be worrying about too much of a gangbusters result or trying to get a big win. Between 7 a.m. to 11 a.m., this is all New York time, on a 5-minute chart, we're going to be looking for a retracement lower against the London session momentum of the day. Using the bullish optimal trade entry pattern and keying off of the 62% level, notice I refined it just to that level. We're not looking for 70.5. We're not looking for 79% retracement level. We're looking specifically right at the 62% retracement level. But now, since we're buying, we're going to add 5 pips for the spread for entry. You can see the example over here. We have our low right after the 7 a.m. time period. The market makes an attempt to rally, and then we start seeing a retracement. As soon as we start seeing a retracement, we run our fib across the range. 62% retracement level right here, plus 5 pips. That puts us in around here. And price runs up, takes out the high here, and then continues to move higher. Long stop loss placement process. Using the low between 7 a.m. and 10 a.m. New York time as your foundation to the long entry, place your protective sell stop at the low or 5 pips below it. That's right here. Do not move the protective stop until 20 pips has been scaled out of the position. Move the stop higher to lock in 5 to 10 pips after first scaling out, or price moves above your New York session initial high. That means where you anchored your fib prior to the trade entry. If prices run to your stop, do not take a re-entry on the trade. Long position targets. Take first scaling off just before returning to the initial high of the day or the high of the day. Take another scaling off at target 1 on your fib tool. Take another scaling at target 2 on your fib tool. If news is due out late New York, post noon time, again New York time, leave a small portion on to see if a symmetrical price swing can be reached. If it does ever, intraday, hit a symmetrical price swing, close all the position. Now, there's going to be times when the market will continuously run and you'll regret having closed everything at the symmetrical price swing. Trust me when I tell you, more times than not, it's better to do it because it usually peters out and runs out of steam. Only a few instances out of a year, you're going to see how it just starts to go, careening past the symmetrical price swing. Unless we're in something obviously, very fast marketplace, it's not going to do that. It'll usually respect the symmetrical price swing, at least in terms of capping the daily range, especially if time of day overlaps like London close or 2 to 3 o'clock in the afternoon with bonds closing. Okay, so now we're going to define the sell program. Shorting only when the daily has taken out a swing low in the last 20 days if the